The United States just crossed $36 trillion in national debt. That's larger than the combined economies of China, Japan, Germany, and India. It's more than every household, business, and government in the European Union owes combined. And it's growing by roughly $1 trillion every 100 days. Which means, by the time you finish watching this video, the US will have piled on another $70 million in fresh debt. So if you're wondering who is going to buy all this debt, the answer used to be obvious. Foreign central banks, pension funds, sovereign wealth funds, the usual suspects. But that answer is quietly falling apart. And the people whose job it is to tell you this are the same people who get paid not to. But before we get to who's actually left holding the bag, you need to understand why this matters. Because the only way $36 trillion in debt doesn't blow up in your face is if there's an endless line of buyers willing to fund it at low rates forever. And that line is getting shorter by the day. If you ask 10 Americans on the street what backs the US dollar, most will say gold. Some will say the government. Both are wrong. The US dollar is backed by exactly one thing, and that's the global appetite for US Treasuries. It's a circular system. The government issues debt. The world buys it. The dollar stays strong. The cycle repeats. But that cycle is breaking. And there are 3 reasons why. Let's start with the first one. And it's the one nobody on CNBC wants to touch. Foreign buyers are walking away. For decades, foreign central banks were the marginal buyer of US Treasuries. China, Japan, Saudi Arabia, the United Kingdom, they all parked their reserves in US debt because it was the safest game in town. At its peak in 2013, foreign holders owned around 34% of all outstanding treasuries. Today, that number is closer to 23%, and it's still falling. China alone has dumped over $400 billion in US Treasuries since 2021. Japan, the largest foreign holder, has been a net seller in multiple quarters as the yen carry trade unwinds. And Saudi Arabia, which used to recycle every petrodollar back into US debt like clockwork, has been quietly diversifying into gold, infrastructure, and even Chinese yuan-denominated assets. The same Saudi Arabia that built its entire economy on selling oil for dollars is now hedging against the dollar. Let that sink in. So if foreign buyers aren't showing up anymore, someone else has to fill the gap. And that brings us to the second domino. The Federal Reserve, which spent the last 15 years being the buyer of last resort, is now a seller. During the pandemic, the Fed's balance sheet ballooned to nearly $9 trillion as it absorbed treasuries and mortgage-backed securities to keep the system liquid. Today, that balance sheet is shrinking by roughly $60 billion a month through something called quantitative tightening. Translated out of central bank speak, the Fed isn't just refusing to buy new debt, it's actively rolling old debt off its books, which means the single largest buyer of US Treasuries over the past decade has officially exited the chat. So, who's left? Foreign central banks are out. The Fed is out. Who picks up the tab? And this brings us to the third domino. And it's where the story gets uncomfortable for every American watching this video. Because the answer is hedge funds, money market funds, and you. Hedge funds have stepped in through something called the basis trade. It's a leveraged arbitrage between Treasury futures and cash treasuries. And at its peak, this trade was estimated to be over $1 trillion, run at 50 to 100 times leverage. The Bank for International Settlements has flagged it as a systemic risk 3 separate times in the last 2 years. Because if this trade ever unwinds in a panic, like it briefly did in March of 2020, the Treasury market freezes. And when the Treasury market freezes, every other market freezes with it. Your 401k, your home equity, your job. All of it traces back to a functioning Treasury market. But before we get into why the long end of the curve is where the system actually breaks, a quick pause because in this video I used Whisper Flow. Whisper Flow is voice to text that actually works, and it's completely changed how I research these videos. Each one takes 20 plus hours of digging through Treasury auction data, Congressional Budget Office reports, and Federal Reserve filings. The reading I can handle, it's the note-taking and typing that kills me. But Whisper Flow fixed that. Their voice-to-text is 4 times faster than typing, so I'm getting hours back on every video. And it works seamlessly in any app on any device. I just switch tabs and talk. If you're interested in trying Whisper Flow, then link is in description. Thank you to Whisper Flow for reducing my work in this video. Now, back to where the system actually breaks. The US Treasury issues debt across what's called the yield curve. There's short-term bills which mature in under a year. There's medium-term notes which mature in 2 to 10 years. And there's long-term bonds which mature in 20 to 30 years. The longer the duration, the more sensitive the buyer has to be to inflation, default risk, and currency debasement. And here's the problem. The Treasury has been quietly shifting its issuance toward the short end of the curve. In 2024, roughly 70% of all new debt was issued in bills, not bonds. That's not normal. The historical average is closer to 20%. So the US Treasury is essentially refinancing the national debt on a credit card instead of a 30-year mortgage, which works great as long as short-term rates stay low. But if rates stay elevated, every refinancing cycle costs more. And that's exactly what's happening right now. The numbers here are flat out insane. The U.S. is now spending over $1 trillion per year just on interest payments on the debt. That's more than the entire defense budget. It's more than Medicare. It's the second largest line item in the federal budget, behind only Social Security. And the Congressional Budget Office projects it'll hit $1.7 trillion by 2030. To put that in American terms, every working American is now on the hook for roughly $6,000 a year, just to cover interest on debt that was issued before most of us were even paying attention. Not the principal, just the interest. That's a brand new car payment, every year, forever, just to keep the lights on. So let's go back to the question from earlier. Who is going to buy all this debt? And the uncomfortable answer is, increasingly, nobody wants to at current prices, which is why the bond vigilantes are quietly returning. If you've never heard the term bond vigilantes, here's the quick version. Back in the 1980s and 90s, bond investors had real power. When governments ran irresponsible deficits, bond investors would dump treasuries, push yields higher, and force fiscal discipline through the market. James Carville, Bill Clinton's political advisor, famously joked that he wanted to be reincarnated as the bond market. Because then, he could intimidate everybody. He wasn't wrong. For the last 20 years, the bond vigilantes basically went extinct. Quantitative easing, foreign central bank demand, and trillions in global savings kept yields suppressed, regardless of how much debt the Treasury issued. Politicians figured out they could spend whatever they wanted with no consequences. And for 2 decades, they were right. But over the last 18 months, the vigilantes have started showing signs of life. Long-term Treasury yields have been stubbornly high, even as the Fed has signaled rate cuts. The 30-year yield has flirted with 5% multiple times, levels not seen since 2007. Term premium has gone from negative territory to its highest level in over a decade, and every Treasury auction is now scrutinized for weak demand, with bid-to-cover ratios dropping and tail sizes growing. Translated out of bond market speak, buyers are demanding more money to hold U.S. debt, and they're getting pickier about when and how they show up. Ray Dalio, the founder of the world's largest hedge fund, has been screaming about this for 2 years now. He calls it the big debt cycle, and his argument is simple. When a country's debt service grows faster than its economy, the math eventually breaks. And when the math breaks, the central bank has two choices. Either let interest rates rise until the debt market clears, which crushes the economy, or print money to buy the debt yourself, which crushes the currency. There's no third option. There never has been. And we've seen this movie before. In 1976, the United Kingdom, a developed nation with a reserve currency and a sophisticated bond market, had to go hat in hand to the International Monetary Fund for a bailout, because nobody wanted to buy their debt anymore. In 2022, the UK got a smaller preview when Liz Truss announced unfunded tax cuts. The bond market revolted. The pound collapsed. And her government lasted 45 days. 45 days. That's how fast the bond vigilantes can move when they decide to. And this is where it actually matters for you, the American watching this video, because the 10-year Treasury yield isn't just some nerdy number on Bloomberg. It's the foundation for nearly every interest rate in your life. Mortgage rates are anchored to it. Auto loans are priced off it. Credit card rates, student loans, small business loans, corporate bonds, and even the discount rate analysts use to value the stocks in your 401k all trace back to it. So if the bond vigilantes are returning and long-term yields stay elevated, here's what actually happens in your life. Mortgage rates stay above 7%, locking an entire generation of Americans out of homeownership. Corporate refinancing costs explode, which means layoffs, slower hiring, and tighter credit. Stock valuations compress because future cash flows get discounted more aggressively, which means your retirement account stops growing the way it used to, and the federal government has to either cut spending, raise taxes, or print more money, which means more inflation eating away at every paycheck you bring home. There's no painless way out of this. Every option hurts somebody. The only question is who gets to decide who hurts. And there's a reason traditional financial media isn't covering this. It isn't clickable. Because U.S. national debt hits $36 trillion is a headline that's run 1,000 times. Everyone's numb to it. But the structural buyers of U.S. debt are gone. The Treasury is refinancing the country on a credit card, and the bond vigilantes are returning to discipline the most indebted government in human history. Well, that doesn't quite fit in a Chiron. So if you want to actually understand what's happening in markets and in your country, hit subscribe. Because I can promise you one thing. The financial system was sold to you as something stable, something boring, something where the adults in the room would always figure it out. Low inflation, manageable deficits, smart people at the Fed quietly steering the ship. And for a long time, all of that was true. But there's a part of the pitch nobody ever mentioned, that the same system that worked when the world had endless appetite for U.S. debt doesn't work when that appetite dries up. That the deficits we ran for 40 years were only sustainable because foreign buyers were forced into our bonds by a global system that no longer exists. And that the bill for 4 decades of easy money is finally coming due. So the next time you hear a politician on TV say the debt doesn't matter because we owe it to ourselves, remember this video. Because we don't owe it to ourselves anymore. We owe it to a shrinking pool of buyers who are getting less interested by the day. And eventually, somebody has to pay the bill. The only question left is who.